Hello, everyone. Welcome to the Green Bond Pricing in the Primary Market, H1 2021. We're very glad to have you here with us today. We would like to thank our sponsors, JP Morgan, Credit Suisse, Ping An, Moody's, ESG Solutions, Luxembourg Green Exchange, Citi, Refinitiv, BNP Paribas, IHS Markit, Alliance Bernstein, FSD Africa, Inter-American Development Bank, ICMA, Mizuho, IFC, and Ashurst. Before we start, I just have a few important reminders. Please use the Q&A box to ask your questions. Thoughts, comments, and any other queries about the conference can be addressed via the chat box, where we have our team ready to assist you. Live interpretation is available in Portuguese, Spanish, Mandarin, and French. The headphone icon on your screen will lead you to the options. All sessions are being recorded and will be available to you on this app until November. Make sure of the very exciting tools that Swapcard offers. Network with thousands of attendees and visit our virtual booths where you'll find more information about our latest reports and learn more about our incredible sponsors. Members of the media, for any interview requests, please visit the Climate Bonds virtual booth. Our comms team is ready to assist you. Over to you, Manuel.
Thank you, Letizia, and welcome, everyone. Welcome to the Climate Bonds Conference, the webinar on primary and secondary market pricing. Many of you may not dial in for the first time. You may have been here before, and some of the speakers will be known to you. I've had the pleasure to moderate earlier. Our infamous Caroline Harrison is with us, the lead author of a whole series of those research reports. I think it's the 11th or 12th, isn't it? I've lost count, I admit. And we'll discuss with a great lineup of speakers. My name is Manuel Adamini. I presently work with BMO Global Asset Management, which many of you know will shortly merge into Columbia Threadneedle Investments. In the interest of full transparency, I should also say that before March, I did work at the Climate Bonds Initiative and was a colleague of Caroline. So it's a pleasure to be back. It's also a pleasure to discuss this very specific aspect of the green bond market, notably the pricing and the performance. I mean, after all, yes, we are in it for the climate bang for the buck, and given the latest IPCC report, we should hurry and hasten to secure that climate impact. But after all, we're also here to make sure there's a good yield, not only a climate yield, but also a monetary yield. And this is what we're going to look at. I can tell you, I'm sitting here in a hotel room in Düsseldorf now, my lovely home country of Germany. I don't trust the internet connection though, so bear with me. But I just did a live act, would you believe, regarding green bonds. And the interest was significant. There were lots of bankers in the room and people who work with charities and German pension funds. And a lot of the questions, that I don't say that to please you now, a lot of the questions were around pricing and performance. So what we're discussing is very topical. I'm pleased to now hand over to you, Caroline Harrison, Senior Research Analyst at the Climate Bonds Initiative, and the face and name and brain behind this great research. Give us a bit of an introduction of your latest and new, I heard, findings.
Thank you, Manuel, and thank you, everybody. Welcome to this pricing session. So if I could just have the first slide. For context, I would like to remind everyone that the first half of 2021 experienced record green bond issuance, and $226 billion of green bonds was added to the Climate Bonds Green Bond database. Our research captures around 35% of that amount, and among that includes 6 sovereign bonds from 4 issuers and 15 first-time green bond issuers. We are very keen to encourage more issuers to come to the green bond market, and we view first-time issuers bringing benchmark-sized bonds as a very positive development for the market. So if we could move to the second slide, I will then move on to stating a few facts. I like facts, because I am a research analyst. So, first of all, I just want to remind everyone that we are in a period of post-crisis recovery. So, any investor in, investing in this type of environment would naturally exercise caution about overpaying for any asset that could be hurt by rising interest rates. And this is something that is applicable to all categories of bonds, not only green bonds. Secondly, the green bond supply has increased, as I have explained on the previous slide. However, demand continues to also increase from all sources. Hence, there is still a shortage of benchmark-sized green bonds. Regulation will gradually limit investors to buying sustainable assets. So until all the debt is sustainable, I do not envisage that we will find an equilibrium in this market. Third fact, the greenium is alive and well. Investors have been selective in their purchases, which has played out in the book cover and the spread compression we saw in the primary markets in the first half of this year. These metrics were very subdued compared to what we had seen in the previous observation period because of the lack of supply. We are still seeing evidence of a greenium. So although the book cover and the spread compression in primary a little bit lower, the outcome is still a greenium, suggesting that these bonds are still attracting a core of serious investors. For our research, we only include a greenium if we can build a yield curve ourselves and see it ourselves. But in addition to what we see, we receive constant communication from brokers of multiple other examples of better pricing as a result of the green label. So the greenium is alive and well and has not yet evaporated. So if we could move on to the next slide, I will briefly summarise the performance in the first half of 2021. So this consolidates the points that I've just made, and we saw that green bonds in both euros and US dollars performed well on all metrics. Particularly noteworthy, I think, was the allocation to green investors, which on average reached 66% in the first half of this year. That's the highest we've ever seen, and it's an increase of 18% on the prior observation period. So if we could move on to the next slide. We have, for some time, wanted to extend our research to look at green bond pricing in the secondary market. And our partnership with Tradeweb has made that possible. So after the crisis period in early 2020, we heard from numerous investors that green bonds had retained sufficient liquidity to transact during the worst of that period. And we wanted to know whether these claims were supported by data, facts, in other words. Looking at a sample of euro-denominated utilities, we set out to answer the burning question, which was, if an investor bought a euro-denominated utility bond issued in 2019, what difference would the green label have made to its liquidity in 2020? So on slide 7, we will see that using data based on recorded transactions for bonds in our sample, we observed that the average number of green bond trades was higher in 11 out of 12 months of 2020. The green bid offer spread was narrower every month in 2020. The average bid offer spread range was narrower for green bonds. And finally, the green bond average turnover was greater in 7 out of 12 months in 2020. So on slide 8, this kind of summarises the point of this research, which is, altogether, we view the outcome of this research as very positive news for buyers of green bonds. Investors may pay more for green bonds bearing the green label in the primary market, but their value in the secondary market could help to justify that extra cost. So firstly, we already know that broadly speaking, green bonds tighten by a greater magnitude than equivalence in the secondary market. We are about to publish our 12th paper in our green bond pricing in the primary market research series, and that backs up that fact. Secondly, based on the German twin bonds, we have been able to observe that yield volatility tends to be lower for green bonds compared to equivalents. Admittedly, the sample for that is very limited, but nevertheless, it is an accurate one. And for anyone wishing to look for more data on green bond volatility in the secondary market, please, I encourage you to refer to the Anthropocene Fixed Income Research Institute, who have done further research on this point. And finally, we now have evidence to suggest that green bonds can offer investors extra flexibility in the secondary market. Being able to sell a green bond when times get tough, or being able to sell any asset when times get tough at a price that is agreeable to the seller is actually priceless, because, during a crisis, if an investor needs to fund redemptions or other unexpected costs, owning a green bond would make this much easier to do. So that concludes my short and hopefully not too dull presentation. I will now hand back to Manuel, who will interrogate our panel to learn whether their experience matches what the data has told us. Thank you, Manuel.
Thank you, Caroline. Well, interrogate, I hope they will have a good discussion amongst themselves and not need me that much. But great findings. Thank you for that. And as I said, just discussed here at site in Düsseldorf as well. So, even if you have to pay up a little bit for green, investors aren't crazy. You may make up for that with extraordinary secondary market performance, or it may be justified because of lower volatility, and or you may be better able to say at possibly a better price with a narrow bid-ask spread. That's summarizing your key findings, and the latter ones on bid-ask spread have been new ones. So I recommend everyone to read the paper once it's published. We now have a great lineup to discuss all of this, and you won't be surprised to hear that the Climate Bonds Initiative succeeded in bringing everyone from the marketplace together so we can look at the subject matter from all angles. We clearly have Caroline participating as a speaker as well, who knows all the background to the research. What you've just heard is just the tip of the iceberg. We have a representative from Tradeweb, which is the marketplace where all of this happens, and clearly these are the people who know what the bid-ask spread looks like. We have people who buy up that stuff, either on a line-by-line basis, if they so please, let's say PensionDanmark as a Danish pension scheme, or in whole baskets once they make their way into indices. That would be Lyxor asset management, specifically Lyxor ETF, and clearly also experience from an issuer, FS Italiane, the Italian railways. So we can look at it from all those different perspectives and see whether or not Caroline's findings make sense and how far they may or may not be justified and resonate with market practice. So we have from Lyxor Asset Management, Francois Millet, who many of you may have seen before, and you can see the small icons with the names to know who is who. We've got Erik, Bennike, Head of Credit at PensionDanmark, the big Danish pensions manager. We've got Simon Maisey, MD and Global Head of Corporate Development at Tradeweb, the marketplace. And last but not least, the ladies should have been first, Vittoria, Iezzi, Head of DCM at FS Italiane, the railways. Well, maybe just to kick us off, and after that, let's make it a free-flowing discussion. Simon, can you just reflect on some of the findings that Caroline has presented and what you see in the market?
Great, thank you, Manuel and Caroline. It's great to be here. So it's interesting you mentioned, then Caroline, you were talking about the kind of issuance and the bid-offer spread. I mean, we're also seeing some of the things we can measure. We're seeing like an increase in volume. So we've seen an almost 70% increase in the volume of green bonds trading on Tradeweb the first half of this year compared to last year. We also see that the green premium actually in the secondary market continuing to expand, so that the kind of green premium growing over time as the bonds trade in the secondary market, as well as you mentioned, the kind of bid-offer spread. So it kind of really just shows there's an increasing interest and focus on green and social bonds. And then also kind of more anecdotally, we're seeing increased interest from our buy-side clients asking us to flag those bonds on the Tradeweb screen so they can tell like what are the instruments they're trading. And then from dealers who are making prices, want to isolate out how are they performing in these specific bonds, green bonds in particular, separated from the rest of the bonds they're trading. So they can really measure like how is their performance specifically in these green bonds. So as I say, it feels like it's a really increasing focus on this space.
Well, that sounds like largely confirmation of what we have heard, isn't it, Simon? Is there anything that struck you as, we haven't seen this before, maybe it was just a one-off, anything that you're still dubious about?
I wouldn't say dubious. I think the continued volume growth, I mean, we've seen that back from we started measuring this in 2018, like it's really steady kind of 60 to 70% compound annual growth. It kind of feels like that's going to keep going. And I think the other bit that is, again, not dubious, but like this green premium on the German bonds after it's been issued, the fact that that's continued to expand. And now it's if you look at the pairs of bonds on the 10-year bond, 7 basis points really is like a massive premium. You take the kind of underlying yield on those bonds. So that to be the premium on a green bond just shows the level of demand for these bonds.
Well, indeed, 6-7 basis points on German government paper is a lot to give away these days, isn't it? Erik, how do you look at those things from a portfolio management perspective? You got to make some return there.
I think you're putting me on the grill here, but that's of course the challenge here, because I would say, boringly enough, I would also confirm what has been said, that when we trade these bonds, and I mean, I mostly deal with the corporates and to a lesser extent on the sovereign side, but we can definitely see the greenium in real life. We can see it for sure in the primary market, but we can see it for sure in the secondary markets as well. And you can say we try to, I would say we justify this. We don't try to, but we justify the greenium and still buying into the green bonds by using a simple economist's argument. I mean, this is all seen through the prism of supply and demand, and that makes it a little bit simpler to kind of understand what's going on. And it is really about supply and demand, and the demand currently vastly outpaces the supply in this area. And if you don't have an expectation for that to change materially, then buying stuff that is expensive but have the potential to be even more expensive still makes sense. So it doesn't have to be a contradiction, really. But of course, there is a limit to how far you can stretch that argument. And then it will help that we can also use some of the other arguments that was also mentioned during Caroline's presentation, that we also feel liquidity is better in the green bond space. However, I would say it is pretty skewed to the extent that it is easier to sell. Yes, again, looking at things through the prism of supply and demand, because there is a lot of demand for this. But it also means that if you want to source bonds in the secondary markets, I mean green bonds, that can be difficult. So you can say, yes, the liquidity, you have the right rate risk, if you will, in this trade, given that if you need the liquidity, the odds are better that you will also find it when you need it. So I would say that's probably the some of the main argument. And then the volatility argument, I think, also holds true to some extent. It's a little bit less easy to argue if you have the same issuers or bonds from the same issuer, that the volatility should be vastly different. I might be a little bit skeptical about that, but you can definitely see it between issuers that are comparable in credit quality, even sectors and stuff like that. That there is this tendency of hoarding in the green bond space, if you will, that once people have their bonds, they will stick to them.
Let me pick out exactly that point, Erik. I mean, fantastic that the liquidity works at least one way, i.e. if you need to get rid of the paper, you can, which in terms of risk is good to know. But clearly, sometimes people also have to source huge quantities of green bonds at a time. For example, if you're a tracker and they make it into the index, then you just need to buy out the paper. How is that turning out for you, Francois?
Yes, sure. So, we are handling large baskets, effectively, replicating indices of 560 green bonds in a significant amount, because we are talking of funds which are in excess of $500 million and €500 million of assets under management. So basically, what we are seeing and what's new from last year is that we see a significant decrease in the bid-offer spread of the underlying baskets of liquid euro and dollars denominated bonds over 300 million, which is more or less the same universe as the one of the study. We see this bid-offer spread has been reduced from 30 basis points a year ago to somewhere between 20 and 25. So this is absolutely very significant. The next point is that we see that the market makers, the traders globally, are now making access to large green bond markets so efficient, thanks to this increase in liquidity, that through an ETF, you can have a narrower bid-offer spread than by buying the underlying bonds individually. So you see typically the most aggressive bid-offer spreads are KfW with 5 basis points. The French OAT Vert, the 30 billion one, is 12 basis points. A utility would be something like 20 basis points, of course, depending on the duration. But if you take the big baskets, now you are able to source baskets at average bid-offer spreads that could be below 20 basis points, even for 50 million and plus, while the average of the underlying basket is around 25, because these traders are handling so huge quantities of bonds, green and non-green, which they are trading in principle or in agency, which they are also taking on the books whenever necessary, that they are able to deliver baskets which are just composed of green bonds eligible under the indexes, which have been, by the way, qualified as green according to the criteria of the CBI, and we can do that in tighter spreads than we find individually when you do the weighted average of the bid offers of the components, which is quite new, because it was something which was impossible to achieve something like 2 years ago. So yes, we certainly see this increase in the capacity to source large baskets from all our trading participants. Yeah.
And how far does that, and I'll be to you in a minute, Vittoria, but and just picking up that point that Francois just made with Simon, and how far does that resonate or maybe contradict what you have described you're observing or hearing back from the dealers and their increased interest in green, or their increased looking after green?
Yeah, I think it ties exactly what we're seeing. So like some of the other ways we would maybe kind of measure that to try and quantify it, if we look at the number of dealers quoting the green bonds versus the non-green bonds, both in corporate bonds and government bonds now, the gaps, there's almost there. There's just like 1 or 2 dealers that are not on for both of those. So I think the kind of dealers are all there on those bonds. I think the one area where we do see a difference, if you look at the kind of buy-sell ratio, so if we take our government bonds in total, that we see it, maybe it's kind of 50 to 56% kind of buys versus sells, just as the kind of assets under management expand. We look at that for the green bonds, it's more like 62%. So not a massive difference, but I think enough of a difference there to show there is more demand. Investors are buying and holding the green bonds. And again, that contributes to the kind of green premium.
Now I'm keen to see, we've made a couple of observations on the market. It seems you're reinforcing the same points, which isn't boring at all, Erik, but it's good to know, and it's real life confirmation of research findings, and sample sizes are always limited, so it's good to hear from multiple sources. Vittoria, sorry I had you wait so long, and you're coming in last again as the lady, but I'm just keen to hear in how far this resonates with your experience. I mean, sample size N is just one in this case, but you've issued multiple bonds. You can observe how they're going in the secondary markets. You've been in the DCM space for a while. So I'm just curious, how is it going with your bonds?
For sure, as an issuer, we feel a strong responsibility in this context. So I think that Caroline research outcome is for sure agreed. by the company and not only from the investor perspective. So what we should do as a company in order to preserve this greenium and in order to preserve the supply and the demand balance in the near future. I think we should start being more conscious in our approach. As Ferrovie, we started issuing our green bonds in 2017, and we had a very ambitious approach because we were the first incumbent, railway incumbent in Europe to issue green bond to finance trains. And we decided to issue green bond just to finance the best-in-class assets of our fleet. And we decided to have a report which compares trains versus trains. So it could be an easy game to convince investors looking at the modal shift, not versus other trains, but versus other mode of transport, such as airplane or car. But we decided to have another approach. And these were very successful in convincing investors and in sending the reliability of Ferrovie in the context of sustainability. But now we have to do more in order to preserve this kind of interest, and we are working on our report because for sure EU taxonomy is very important in this respect, and we're doing our best in order to be more aligned as possible. We had our last issuance in last March, and we understood that for sure there is no more room for plain vanilla bonds, for brown bonds. So we are having an approach in order to select any kind of asset vis-a-vis a sustainable product. And we are assessing the presence of a greenium not only in the bond market, but also in the loan market, because for sure there is interest from banks and other kind of institutional investors for labeled transactions. So we are doing this best in order to answer to investor perspective and feelings about company behavior and company vision.
Thank you. But the one point that I'm most interested in here, and by the way, Caroline will like your apples with apples comparison in your impact reporting. She's always making a point about that in the research as well. Is after all, I'm keen to understand in how far you as an issuer, Vittoria, observe whether or not all the observations we've just shared about what's going on in the market, with the greenium and so forth, whether that actually leads to more green assets over time. Because, what we're discussing is nice. And there may be a greenium because the paper is green and people just want the green paper. But does that actually lead to more, if there's a higher price being paid, does that lead to lower financing costs for the issuers and then over time to more green assets? Because, Erik has just pinned it down to a simple supply-demand thing. So the question is, will the greenium be sustained, and does it give comfort to issuers like you that it may be sustained and may support lower financing costs over time, which may entice you to finance green assets? Because that's the big question that we're here for in the end, isn't it? It's not just to produce some paper, but green paper.
Yeah, I was mentioning before, there's a great work to be done, because to issue green bonds costs resources, and you have to work on the issuance before and after for the reporting. So it's very important to be sensitive to the selection of the asset, but also to be sensitive in any issue relating to the avoidance of greenwashing. And this is the question for the future. So looking at the look-back period we have in all of our green bond framework, we will have an issue in the near future. So I think companies and investors should work in the same direction in order to be conscious, and also studying any possible solution in order to be transparent and to be ambitious in any respect. So it's not easy, because just to give you an example, in our last reporting and climate bond initiative was looking at it, we decided to insert the measure of the modal shift. But it's not easy to measure the modal shift of in the public transport, railway transport. I think anyone can understand. But we are still studying with our sustainability report and sustainability colleagues, and we will do our best in this respect. So I think this is the key.
Again, the question is, will you put out more assets so people can do more modal shifts in future? Maybe back to you, Erik, because you've simplified it so beautifully before, saying, this is a simple supply-demand question. I would suspect that the CFO at the Italian railways will only dare more aggressively finance more green assets if he or she knows there will be a financing pricing advantage over time, and it will be sustained. If it's a simple supply-demand question, there will be more supply, then the pricing advantage may just vanish. What's your views on that, given that economist lens that you've just applied, Erik?
Well, I think then the economist would say that it would be natural to supply to also increase over time. So I agree that it's probably going to take a while before we get supply and demand in, should we say, more balance. Well, I actually struggle with that notion, because supply and demand will always balance. It's just a question of where the price is clearing. But nevertheless, you can say if green bonds are to converge in pricing compared to traditional bonds, then it would certainly require a lot more supply, as the demand picture looks right now. And I think that will take years before that actually happens. So I don't think we necessarily disagree, but I just wanted to comment on the thing you mentioned about the CEO and sort of the business case for issuing green bonds, which I think then even with my economist hat on, I would say is too simplistic, because you'll probably be leaving aside the most important issues of issuing a green bond, which should not be seen as the whatever 3, 4, 5, 7 basis points of yield differential, which may be nice in itself, of course, but can it justify the reporting requirements and so on? I mean, that's a business decision that will depend on each issuer's sort of internal setup. But what it matters a lot to would, of course, be the public perception of the company by issuing green bonds. It will be the message sent to other external parties, such as, maybe not for the Italian railways so much, but with shareholders and with other potential investors in both debt and equity for the future. So I think going down the road is something that most issuers will need to do at some point in time. And there are just others that find it easier to find the assets right now, which is obviously why we see a lot of utilities, financials and sovereigns issuing right now. But that would certainly both need to change, and I think it also will change in the future. But we may be able to come back to that sector thing later.
And Manuel, if I can just jump in there on something Erik said, I think it's interesting talking about at some point does the kind of supply kind of increase such that there isn't such a greening. Actually, you could make an argument that given the focus on this, the increasing focus on the kind of sustainability, that actually it becomes like the minimum and everyone moves up, and actually becomes a penalty for issuing non-green bonds. I mean, have the same effect of like a sort of a premium between the two, but it might switch around like that. And I think the other thing I think that's interesting in this space is just this focus on the kind of the way you see it is like labels, number of labels expanding. So whether it's green bonds, social, sustainability, blue bonds, pandemic bonds, but like I think that there's people want to understand more like where is the money going? What are they holding? What is being financed? And I think that there's I think that is not going to sort of balance out. I think that will just keep increasing. And the interesting thing there, I think, is, and this is kind of some of the great work that CBI are doing, is kind of you need more standards around what do these really mean. Vittoria, you mentioned about greenwashing, but like people really understand, like, okay, you've said this, but is it really that? And I think that's a kind of another thing that we're going to see a trend of, like, sort of increasing scrutiny around what some of these labels really mean and what is happening to the kind of money, what is being financed.
Sorry, Simon. This was the reason, the rationale behind my suggestion about the responsibility of the companies, because labels are increasing, and this is an opportunity for all of us. But we have to be more conscious, and we have to deliver a product which is reliable and it's really sustainable. It seems that everybody is labeling something, and I don't think this is the right direction. Sorry for my. But I don't think it works in the long period. Maybe now it's trendy and anybody is happy to buy a labeled bonds, but we have to study both on the company side and the market side, investors and market side, in order to select what is really dark green, what is sustainable, and what is not. Because before an asset is green, there's a company. And if a company is not sustainable, but the assets are in the marketing direction are presented like very sustainable, this doesn't work, according to me. So we need a balance, and we need to be very selective as companies, and to be ambitious.
We just had the same discussion here at the live event as well, by the way. People were asking, like, you know what, isn't the marking all becoming green? And I will come back to that point that Simon also made in a sec, like, you know, they could flip around, and a premium for green could become a premium for not being green, or a punishment for not being green, if you so will. Just one sec to intervene here. We are getting warmed up. That's great. You guys are, responding to one another. I love that. Just to bring in the audience as well, please do know that we are about halfway the discussion. So if you have any questions, just feel free to bring those in. There's a Q&A function in the application, I've been told, and there are staff at Climate Bonds Initiative who may answer some of your questions in writing immediately. Some that may seem pertinent to the discussion may be pushed through to me, and I can try to pick them up and bring them into the mix. So feel free to participate. Feel free to ask one or more of the panel members, or to bring in your views, which we could then discuss. Well, back to Francois on the concerns that have just been raised. Francois, how do you look at that? Because I take it as a tracker, you just have to buy what comes into the green index, and you may like some bonds more than others, but in the end, your product depends on what's in the index there. So how do you look at those issues?
Yes. So first, I would like to report why there is so much interest in the passive products in general. So what's new and what's going on with the change of attitude of investors compared to 1 year ago is two things, which are both impacting this demand for green bonds. First, investors are willing to align with temperature target scenarios, which was not so much the case 1 year or 2 years ago. Before, they were just dealing with managing their transition risk and looking to reduce their portfolio carbon intensity. So now it's different. They have a forward-looking approach. So they are looking for instruments and securities which are helping to fulfill these new objectives, which is their own net zero objective. Second, investors are themselves submitted to new levels of reporting obligations with the SFDR, where they will be asked to provide advanced principal adverse impact criteria. Like, for example, they will also have to report the green share of their portfolio. They will have to report the percentage of energy consumption or production in the portfolio which is stemming from renewable sources. They will have to report other indicators like impact indicators now, where the instruments which are commonly used in their portfolio, which are equities and corporate bonds, do not really fulfill that objective. So this is why we believe that these two big changes are also strong drivers of demand. And we see that, of course, in our products as well. We buy the market, effectively. We do not do stock picking or stock selection, because our purpose is to bring liquidity. We believe that liquidity brings scale, because it attracts other investors that would otherwise not be there. In particular, private banks, wealth managers are not able to get allocations in primary book buildings of big issuances from big utilities or from the Italian or the German state. So it's important to provide market access, of course. We see the merits of having a basket investment as the merit of immediate diversification, which we all know, and the basket is itself changing its shape with a lot of green bond issuances from sovereign issuers right now. So we see 20 billion of green bond issuance this month are expected from sovereign, especially from Europe, not necessarily Eurozone. We see that the corporate segment is increasing as well. So the baskets, the indexes are following these trends in the market and are adapting to that. And the good thing is that they always provide a suitable level of liquidity because they are market cap weighted, which is based on weighted based on the outstanding amount of issuances, which is generally a very good proxy of the liquidity of the underlying. So that's why this has a complementary role in any allocation. And now you can play index investment in a granular way. You can buy ETFs of sovereign bonds, ETFs of corporate bonds, or aggregate ETFs, and so on and so forth. So you have now a whole toolkit for doing allocation within your fixed income portfolio. You're not obliged to buy the whole market with a global index.
Thanks for a bit of a crash course on why buying green index products. That was good. But I want to bring it back to the individual issuer. And clearly we have Vittoria representing that here. I mean, if the green stuff grows and, it has kept growing over the past and as Erik predicts it may continue to grow as demand outstrips supply, I wonder what happens at some point to the green versus the non-green. Simon has made some point at aggregate market level about that. Maybe we can go back to that as well. But let's stick with the individual issuer. I mean, Vittoria, you as an issuer also, you have green and non-green debt outstanding. Francois' ETF the green ETF may buy this paper here, and another ETF may buy the non-green paper there, and other players as well. How does that relate? How will that develop over time? You guys must be thinking about that.
As Ferrovia, I don't think we will have an issue because we are full of assets, and I do hope that pandemic will be over in the next future. And we have so many contracts with the regions and too many investment to do that we will be plenty of assets to devote to the market, to the green market. As I was saying before, our decision at the very beginning of our entrance in the green bond market was to select the best investment we have in our fleet. But just to give you an idea, maybe around 98% of our assets in terms of trains would be eligible on a EU taxonomy perspective in terms of green bonds. And now we are selecting a very little part in this respect because we are selecting just the regional and high-speed trains and locomotive for the freight transport, which are under construction. So we are plenty of assets, but we will try to preserve the same approach and to deliver to the market anytime the best investment we have in portfolio. Maybe at one day we will decide to add investment, even though they are not the best in class, but maybe in the railway sector, there is no issue in terms of sustainability. So I think that some other companies and other sectors could have an issue in this respect.
So it seems, Vittoria, your company's full of assets, as you put it. Some others may as well be. Maybe you're being too strict upon yourself, which we prefer in terms of climate impacts, evidently. But Erik, we've talked about the need for more supply. How do you pull issuers like that? With Vittoria, it seems reasonably evident. Others maybe a little bit less evident. How do you pull those into market to ease this supply-demand tension?
Well, I think very simply, we're trying to convey with investment banks that we have more broad interest in the green bond market, and even made sort of reverse inquiries at a few occasions where we felt that, because we sit very close to our equity colleagues, so we might have good equity cases where we think these are some of the companies that are actually facilitating the transition and had yet to come to the market with a green bond, which was kind of a conundrum So we encouraged that, and eventually, actually, they issued a green bond. So it was actually a good story, and I think that case is more pronounced the more you get away from the traditional or typical issue of a green bond. But sometimes you may be able to find the unlikely green issuers in the sectors of energy or materials or industrials that are much more interesting from an impact perspective, and maybe also from an economic perspective than some of the, should we say, yet another utility issuer. Sorry, not mean to offend anybody, but we have quite a lot of utilities in our portfolio, and we're quite pleased with most of them, if not all of them. But we certainly like more diversification in the portfolio, just from a portfolio manager perspective. Diversification is important. So that's another reason why we sort of want to encourage also at this forum that potential issuers come to the market.
And how then do you identify those maybe less usual subjects? You've mentioned materials. We could think of heavy industry. We need the wider energy theme, not just energy utilities, indeed, in terms of climate impact. We also got a question from the audience into exactly the same direction, saying, how can we identify sustainable underlying companies, or, as you flagged, Erik, companies being on their journey in the process of transitioning toward a greener business model. Can you explain with us how exactly do you do that? Maybe you have a couple of examples for us?
Yeah, I would say we actually use our cooperation with our equities colleagues quite a lot, because no matter how hard we try to make ourselves proud of one another, then we have to say typically the equity market might be slightly more forward-looking than credit markets are, and that's why it's actually a pretty good place to start if you want to see where are sort of the real action happening, where do people expect the real transition and the foresighted companies to emerge, and that's why I think it's an obvious place to start, and that's why right now I would say green in transportation, for instance, is still very much focused on should we say, railways and few select others. But then over the past year or so, we've seen some of the large car companies actually come to the market to also tap into this, which makes a lot of sense. And it's just nice for us because we can both buy into a new sector, provides more diversification, and actually think it might also move a little bit more, because I think this is very much also about instigating change, and that has sort of we've put the ball in motion. I wouldn't say we have, but the world has put the ball in motion for the utilities to a large extent, especially in some parts of the world. But there's a lot more to be done in other parts. But I don't know about specific examples, but I mean, just as recently as yesterday, we saw Mondelez come to the market. I think it was not a green bond, but a sustainability bond. But still, I mean, it's one of those companies where it might not be as obvious for them to find these use of proceeds, but still, if they do an effort, it could be possible. So we love to see that.
So you're collaborating with your equity colleagues to work forward-looking, identify companies. Now, I'm curious, Simon, in how far maybe dealers also have a role to play. We've heard the bid-ask spreads are a little bit narrower for green, so that could be an interest, just a simple business interest on the part of dealers to say, let's widen that a little bit more again, so we can make more money, and at the same time growing the market by bringing in both more demand and supply, so they can have a bigger slice of it. I could imagine dealers looking at that and saying, "Hey, here's a company that may have more headroom to do more green," and I don't think this has really been discussed in the market. What could be their role there, if any? Maybe there's none. You know the business better, Simon.
Well, I think there's two parts to that. The first part is on the issuance side, on the DCM side. I'm sure they're all out talking to their clients around. There is this demand, there's a green premium, like it would be cheaper for you to issue green bonds, which is actually like that is what should be happening. Like people want this kind of change. I think on the price making side, that they want to, they realize this is an important issue. It's an important issue to investors, to their clients, but also to employees, that they want to be part of this thing and showing they're doing a good job. So that's why we're seeing dealers asking us, like, what's my ranking in green bonds? And in many cases, it is different to their ranking in like the non-green bonds. And they want to understand that, and they want to like sort of shout about that, whether that's internally or with clients, when they're saying, like, we're more active in these bonds and we're making a difference here. So it's absolutely not about trying to widen bid-offer spreads, but it's more about being active and being a kind of key participant in this kind of development of the market. And we're seeing that a lot now, like questions from dealers. We're providing that reporting so they could just split these out themselves.
Cool. And just conscious of time and also looking at some questions, we got one there from you, for you, possibly, Francois, whether or not we will sustain a greenium. The question that we got from the audience at this point is, okay, there is a greenium. Is that really fair to pensioners? Is this a good game? I'm paraphrasing the question, saying if there's already extraordinarily low, if not negative yields anyway, and you get make a pension in future, what then? Is it fair? Does it make sense to even pay up for green? Can we ask that from pensioners? One of the audience members asking. I guess that may be one for you, Francois.
I mean, the question of the fiduciary duty of pension funds to manage assets in a main objective of seeking returns is not conflicting with the one of greening these portfolios. Effectively, we have a tendency to have very long durations in the green bond market by definition. We have a tendency to have prime quality names, so we have a lot of investment grade, of course, in the green bond market. For example, if we take a global euro and dollar investment grade portfolio, we are talking about a yield to maturity or a yield to worth of around 0.5% globally, including the new sovereigns. So it's not a lot. If you take a pure corporate one, for example, it's not much higher. It's more or less the same because it's 5 years duration instead of 8.5 duration. So we are still talking about poor returns. The question of the greenium is not really interfering with that. I mean, we are talking about slight return differentials. We are talking about greeniums in the primary market, which are ranging between 1 BP, 1.5 BP, 2 BP, which could go up to 4 BP. It's a secondary market, 5 BP. So that's not, well, totally changing the landscape in terms of a global expectation of returns when you're committing on long durations in any case. So I think, well, the real issue is either another utility function, which your green bonds are fulfilling in your portfolios, which in a certain way are sheltering yourself from long-term carbon debt, which is embedded in issuers which are not going at a high pace enough in their transition. And from that perspective, normally over the long run, investing into companies which are issuing more green bonds and investing in the green bonds themselves should be a form of management of the long-term risk on behalf of your pensioners.
What's the views you hear back from PensionDanmark's pensioners, Erik? Are there any pronounced views on this subject matter by your constituency?
Not to a significant extent, I would say, but I think the question is more sort of fundamental around what do pension funds do about the negative yield, right? And it's not really the topic of this conversation, but I just say, well, we buy less bonds. That's the very, very simple answer to the question, just to provide some color on it at least. And then probably just adding a little bit more flavor to it, I would say it's also, I would be provocative and say 0 is just a number. And the problem is we would need to put people's money somewhere. And if the alternative suggestion would be that we buy 100% equities because they don't have a guarantee to yield negative, at least, I would say that that's probably not the right solution either. So yes, we buy less bonds because yields are very much compressed, but we have to buy bonds especially for those members we have that had limited investment horizons. So that's sort of the simple answer. I don't think also, as Francois said, the yield differential here doesn't really change that. And I think the decision to buy green bonds versus traditional bonds is one we have talked about, and it's more driven about these other topics of liquidity and potential to compress even further and so on.
Good. Thank you. I mean, these were a few, 2-3 very specific questions we got from the audience. Thank you for helping answer those. I think, conscious of time, we got 6 more minutes to go. We have had a pretty robust discussion of Caroline's research findings from all different angles, the buy side, sell side, intermediaries. So that's really good. I'm now keen to maybe hand back to Caroline and just ask you a couple of questions, Caroline. One is, in how far does all the panelists discussed resonate with you? Is there anything that you have heard that you think, hey, this may be an area for future research, or things you had on your mind anyway? You may just want to inform the audience of Climate Bonds plans, research plans in the pricing area going forward. Or has there been anything that contradicts your findings that may also be interesting? So the last word on content should probably be for you, Caroline.
Well, first of all, for future papers, one of the things that we are considering looking at is whether companies that have a robust transition plan in place get more beneficial pricing on their debt, green and otherwise. And that kind of links to Erik's point on the subject of the relationship between the equity and the fixed income. If the company is well run, then we want to see that company bring green bonds, and those green bonds undoubtedly will do well in the market. I think the panel has also touched on the need for more diversity in the market. We always look for, encourage and welcome a more diverse set of issuers, but we equally encourage existing issuers to come back to the market. So repeat issuers offer economies of scale, both to themselves and to investors, because investors do not have to repeat the fundamental ESG analysis that they will do on the company if the issuer comes back to the market. And what was the other thing I wanted to mention? Right. The activity of issuing a green bond is from the perspective of the issuer, gives them a reason to audit their activities against climate change. And it will give any issuer a broader overview on where their exposures are and how they can replace existing assets with new assets to help to give them a more sort of robust resilience profile when it comes to the impact of climate change. And finally, just one more point on the topic of supply and demand. I think that every investment discussion now includes some element of sustainability, be that equity, fixed income or anything. Ultimately, it is now investors who are driving this market. And so issuers, please look at your assets and see what you can do to help to satisfy this growing demand by coming to the market with green bonds that have adequate clarity and transparency around the use of proceeds. Thank you. Those are my concluding remarks.
Thank you, Caroline, for this call to action. Indeed, issuers, come to market, come build more green assets. Thank you, ladies and gentlemen. Conscious of time, I'm keen to wrap up. You may have 1 minute left when we adjourn, and you may need that minute for to grab a cup of coffee or whatever before you rush into the next CBI session. We've had a fabulous panel, some very interesting and new research findings presented by Caroline Harrison from the Climate Bonds Initiative. We had Vittoria, Iezzi from FS Italiane, the Italian Railways, as an issuer. We had Erik Bennike from PensionDanmark as a buyer, as well as Francois Millet from Lyxor Asset Management as a buyer. And finally, Simon Maisey at Tradeweb facilitating the marketplace. Thank you. Thanks to the panel. Thanks for the discussion we've had. And thanks to the audience for dialing in and for asking a couple of questions. Have a good day and enjoy the other sessions. Thank you and goodbye.
Thank you, everybody. Bye.